G'day expats and welcome to another episode of Expat Chat, episode number 64 today. And today I am joined by the guru from the Gold Coast, Mr. James Ridley, who's the Managing Director for Atlas in Australia, who looks after our clients in the Asia and Americas region. G'day, James.
G'day, Brett. How you going? And as always, my listeners, I'm listening and collaborating with Brett Evans, the Managing and Founding Director for Atlas Wealth, and currently in the EMEA region, in the sandpit, as we like to say. How you going, mate?
Well, and this is going to be the last episode before yourself and Jeremy, who's the head of our mortgage division, boots on the ground in the sandpit. So this time next week, mate, you'll be enjoying the sunny climes of Dubai.
That's it, pressing the flesh. It'd be interesting to see what the temps are like over there. Obviously, we're still coming out of the cooler period, the winter season, but outside of that, it'll be good to get over there, mate. It's been obviously a long time. COVID's caused a stir where couldn't do too much, and it's stars have aligned to get over there and put on a few seminars. So looking forward to catching up with a few expats over there, and obviously just seeing our usual advocacy points and talking about a couple of crucial topics there. So can't wait, man. It's going to be good.
Yeah, so next week, next Tuesday, the 27th, we'll be in Dubai running a seminar with the Australian Business Council Dubai, talking about the pros, tax residency rules, the petition we've got going. Jeremy's there going to be answering everyone's mortgage questions. You and I will be talking about super investing, the economy, currency. That's a big one right now with the way the Australian dollar takes US. So
right.
I'll put in the links below, folks, to where you can register for each one of those seminars, but seats are going pretty quickly. So definitely get in there if you do have any of those questions or all of them. Please register. But mate, today we're going to run through a pure audience Q&A. So we've had lots of questions, which is coming in. So just before I jump into handing the reins over to you to answer those questions, all the information that we're going to share with you guys today should be treated as information or educational purposes only. Think of it like Sesame Street. At the end of the day, you should not construe any of this information as personal advice, and please speak to a licensed and experienced professional on expat financial advice like Atlas.
Absolutely, mate. And I mean, a good couple of, I suppose, talking points today, which is driven by our Q&A, and I guess, hashtag Ask Atlas. That's what it is today. And I think, the questions that have come through are what I would say quite common. And we're going to kickstart today with one just regarding about keeping your residency intact, regardless of you living and residing overseas permanently. And I guess it's talking about, why someone might actually want to keep their Australian tax residency, say if they're living in the UAE or Thailand or the US. And I guess we've got to go back to the fact that when you look at tax residency and keeping your residency intact, it obviously lets you access tax concessions, whether it's through capital gains tax. Probably the big one would be the main residence exemption, still being able to access that. Other reasons why you might wish to keep your Australian tax residency intact if you're retired is probably off the top, the age pension. I think the age pension would probably be a big one. However, what's unique about the age pension, and when we talk about residency rules, is the Department of Social Services has a bit of a different definition to Australian resident compared to, I suppose, the traditional Australian tax residency rules. So that's right. Yeah, I mean, you could almost say that nearly every state has a different ruling around residency. It's pretty annoying, to be honest. But Department of Social Services, or when you're accessing age pension, has different criteria for a residency versus Australian tax residency. So it's acknowledging that they are different and doing I suppose the relevant work to understand what the difference is and why. But the main question is, can I choose to keep my Australian tax residency intact whilst I'm residing overseas permanently? It's a good question, and we have talked about it before on a previous episode. And it's, I guess the hardline truth is when we think about residency, there are certain criteria that we need to meet. I would say that it is a lot easier to keep your residency than it is going to be a non-resident, let's be honest.
Because the ATO wants you to be a tax resident.
Well, exactly right. It means from their perspective, it's taxation on a worldwide basis, worldwide assets, worldwide income. So of course, they want to keep everyone as a tax resident, especially if we're in the Gulf region or the GCC region, and we're on these tax-free incomes. I mean, there are taxes; they're just called fees, and they're high. So, with that in mind, Brett, what's your, I suppose, perspective, 2 cents on that? Regarding residency, keeping it, not keeping
Yeah,
it. I mean, my
you,
2 cents is it's a lot easier to keep your residency, let's be honest.
it is. And we've had a number of clients do that, and primarily for either age pension or property reasons.
Mm,
One client that comes to mind used to live in China, and she had about 5 properties in Australia. So by saying to the ATO, I'm a tax resident of Australia as well as China,
yep.
what it meant was the Chinese income tax rates are very similar to Australia. So she
Mm,
wasn't paying much more tax, but she was able to benefit from the 50% capital gains discount on her
yeah.
property portfolio. So for her, it was pretty cut and dry. Other times that we've done it with clients, we had one client who came out of Australia. His accountant recommended he didn't do deemed disposal.
Mm-hmm.
And by doing that, he had this little company called Atlassian shares, and those shares went through the roof.
Gosh.
So what would have been a relatively
Yeah.
small deemed disposal amount coming out to
Back
severing
then,
those
yeah.
back then ended up becoming about a $4 million liability.
Mm,
So what we were able to do was go back and amend his previous declarations to being a tax resident. And by doing that, in turn, meant he could get a 50% capital gains discount on his CGT on his shares that were accruing in the background.
yep.
And that's an important one for a lot of folks out there who don't realise about deemed disposal. If you do not pay
That's
the
right.
capital gains tax as you're leaving the country in that tax year, then CGT still accrues, even though shares are non-taxable assets. So that's
That's right.
another time. So there's and thanks to Ian for sending in the question, because to me, there are a lot of different scenarios why people would want to keep tax residency. In the UAE,
Yeah.
no, because
No.
in the UAE
Yeah.
or any low tax environment like a Singapore or a Hong Kong,
That's right.
you'd have to really crunch the numbers in terms of what an Excel spreadsheet would show your gain would be by being a tax resident versus the extra income tax you would pay on your salary that you're earning at the time. So by looking
That's
here,
right.
I'd say with Ian's question, he's retired. So certainly we're
Mm,
talking about, retirement considerations, not earning salaries overseas. So that I don't know how many hundreds or maybe more thousands of statements of advice we've done.
mm,
They're never the same for these reasons, because
no.
everyone's circumstances are always different and what they're trying to achieve and where they're going with it. So yeah, to answer
Absolutely.
my point of view, it does make sense. You can do it in particular circumstances.
Well, I want to keep going on this because even a lot of my clients that work for the UN as an example, World Health Organization, the World Bank, um, even Asian Development Bank, they've got a lot of I suppose legislative pieces where their employment income isn't taxed, so they can still maintain, say, their Australian tax residency, but the wage income they receive is tax exempt. So in those situations, sometimes those type of expats might want to maintain their Australian tax residency because they're getting the benefit of knowing that their wage income is tax exempt, but they're getting the other side of the benefit knowing that they're being able to access the tax concessions. Obviously, it's going to be dictated by your personal circumstances and what might be best, but that can often be the case as well. I will caution any expats that are looking to bounce back for 12 months to sell a main residence to try and benefit from the main residence exemption and then leave again. Be very careful because the Commissioner for Taxation will happily lean on Part 4A of the anti-avoidance rule and drill down on your previous 4 tax returns and go, hang on, they were overseas for 3 years, they bounced back for 1 and then they left again. That doesn't
Yeah.
sound right. That might have been a capital gains tax event if I would have thought. So just be careful of that, really trying to skew it in your favour because the Commissioner won't stand for that sort of, I suppose, rubbish
Rubber
because we've
stamping.
seen it happen before. That's
Yeah,
right.
rubber
Absolutely.
stamping doesn't, people think they can be clever. What they're
Mm,
forgetting that there's people who get paid a full-time job to find people who think they're being clever.
that's right.
So don't try and be clever. Just
No.
stick within that nice big fat piece of legislation. Don't go on the grey
Yeah.
space, because that's when we see the tears and we see the anguish that expats go through because they thought this would be okay. When actual fact, they shouldn't think.
Absolutely. Absolutely. I mean, we haven't heard much from the ATO ramping up its sort of audit side, but we know the IRS is committing another additional 80 billion
$80 $80 like,
to
it's like
tax
building a city.
compliance. Holy
Yeah, that's just like
moly.
building a city.
Yeah.
You know, it's just like we're just going to create a new country.
City of auditors.
Yeah. Oh, they'd be a pretty dull
God,
bunch,
that must
wouldn't
be
they?
fun. Yeah, far out. Shit.
Sorry
Anyway,
to all
mate,
the
I
auditors
think,
out there. Sorry to all the
yeah,
auditors out there.
we
So.
love you guys. Yeah, stigma. Sorry. Anyway, listen, I think we've covered that topic there. It's easy to keep your residency intact. Everyone's situation is different. It might benefit you, based on your asset spread, your income spread. More often than not, a lot of expats that will be overseas will want to be a non-resident. So, they're not doubling up on the taxes there. Unfortunately, Australia does have some very high marginal tax rates, and that's often the reason. So I think that's a good tick off there.
Let's go across to Jim.
Yes,
Jim's question.
the next
Let me
one.
throw this one to you. Yeah.
Okay, yep, you go for it, mate. Yep.
Yeah. So Jim comes up and says, if I'm to be an expat in a few years, should I now be buying ETFs which are total global, such as VEU, and not the likes of VAS, A200, VDHG? Thanks. So, Matt, I'll let you do your bit, and I'll come with my comments as well. But yeah.
I mean, very broad. I know VEU. VEU is an all world ex-United States one. So total global. I mean, you're missing out on the largest
50%.
share market there. Yeah, 60. I was going to say more, 60, 65%. It's a good question though, and I guess with any investment strategy, portfolio strategy, diversification is always key because different markets perform very different depending on what's going on from an economics perspective. Let's look at a good example. Right now, we've entered, we've had a very testing couple of years, haven't we, since COVID? But this year, high inflation, Russia, Ukraine, interest rates on the rise, most indexes obviously down, but the worst impacted would be the Asias, as well as surprisingly the US. And it's mainly probably because of their makeup. When you look at the index breakdown, very large weighting to technology stocks, which we know don't normally perform well through periods of high inflation. Earnings is diminished. They don't pay out large dividends or anything like that. So it's being mindful of that. I think as with anything, if you're heading abroad for a few years, but you're coming back to Australia, you might typically have a home bias because you understand the Australian market and share market a lot better. The ASX blue chips, those sort of things. But I guess when you also look at, say, an ASX 200 ETF or index tracker, you got to remember that when you're buying that ETF, you're exposing yourself to almost 40%. Of probably the big four banks, aren't you? So it's a really tough one, but diversification is always key, not just in share markets, but breaking it down in asset classes. The way I look at it is you've got obviously, from our perspective, you've got Australian share exposure, you've got international equity exposure, and under that banner, you've got the US market, you've got the UK market, you've got the Europe market, you've got the Asia market, you've got emerging markets underneath that. And then you've further got property and infrastructure. And then you've got, I suppose, some alternatives, and then fixed interest. And under fixed interest, there's Australian fixed interest and international fixed interest. If you want to go a step further, then you've got private equity. So there's...
How long's a piece of string? Yeah.
Yeah, that's right. As with anything, it's always going to come down to investor profile, so how risk adverse you are, the time horizon, but diversification is always key. So what are your thoughts on that, Brett?
Mate, I think the fact that whether he goes overseas or not should not dictate what you're investing in. To be honest with you, if you are looking at investing some money, then you should be investing in the best markets and diversifying your investments and diversifying your exposure. So just the fact you're going overseas shouldn't be
mean.
I will, though, caution Jim on a couple of things. So a lot of people, when they're Australian tax residents, will buy these securities through Vanguard themselves. The platform. And the problem is, or it's not a problem when you're a tax resident, but as soon as you become a non-resident, Vanguard will kick you out. You need to make sure that, have that chat with Vanguard early to understand your options, because very, very likely you will not be able to use the Vanguard platform. Don't try and be a clever bugger by putting your family's address on it, because then suddenly your account is still classified as an Australian tax resident, and there'll be no non-resident withholding tax deducted, and it can create compliance and audit hiccups down the track if you're not having the appropriate amount of non-resident withholding tax coming out. And last of all, obviously deemed disposal, you need to be aware of that. if you do buy any shares, Vanguard, BHP, doesn't matter what it is, you will need to sever those ties. Otherwise, you're still accruing, like we said with the earlier question from Ian. You will need to sever those ties from a deemed disposal point of view.
Yes.
Vanguard do a great job, but I agree with your point about the ASX 200. That to me, it's, when you look at 38.5% Australian banks and then 20% resources. Now let's look at two sectors right now that are going to feel the most in the next 12 months. Banks with mortgage rates rising and concerns regarding the property market and mortgage in possession sales. And then B, a slowing Chinese economy with commodity prices coming down. So 60% of your portfolio will be exposed to two sectors. And that's one of the reasons we personally don't use, we use a lot of ETFs in our client portfolio construction. We do not use an ASX ETF unless in exceptional circumstances because of that slanting.
Yep, I agree. Absolutely. And it's a tough one to give a straightforward answer, to be honest, because there's many things that feed into it. I think just because you're heading over to the US or the UK doesn't mean you're just focusing on that sole market. I think my main point is diversify, and I think Brett's right. Just because you're heading over to somewhere else, it shouldn't have an impact on your overall sort of strategy. I think diversifying, picking sort of obviously good markets at all times, not sort of a very small emerging market, I guess you could say, ETF. That's probably running a bit more risk, especially given the current circumstances that markets are tracking right now. I think there's probably additional caveats we can layer on that with, if you're heading to Denmark or if you're heading to the US.
And that's and we haven't qualified that with Jim, and we'll certainly add that ability in the questionnaire. That'll be linked below if you do want to send in questions in terms of what country you're from, because you've hit the nail on the head. It will depend on the country. So do you want to talk about the US side, PFICs, and I'll talk about the Danish side?
Yeah, well, I mean, the US and more strictly the IRS, it does have some strict legislation around investing in what's called a passive foreign investment company. And breaking it down, it's from the US's perspective or the IRS's perspective, it's any foreign company or trust that produces 50% or more of its income through passive means, or 75% or more of its assets do. And the clean layer is just it's, in the eyes of the IRS, any foreign mutual fund or foreign ETF or listed investment company or real estate investment trust, foreign being that it's not domiciled inside the United States. What happens if we own these investments? We have to do a mark-to-market election most calendar years. We're paying tax on unrealized gains, which is a bit ridiculous, and we're paying tax at one of the higher federal tax rates as well. So it's best we just don't have the kind of exposure to those. There's ways you can navigate it, absolutely, but you need to be very careful. Unfortunately, it does cut down your investment menu, especially when you're an expat. So again, you've got to be mindful of that, and I suppose plan accordingly. There's been plenty of times when I personally have had to clean up clients' older portfolios because they've invested in all these managed funds or mutual funds or ETFs, and it's causing them a bit of a tax nightmare each year with their US accountants. So it's a good example. But yes, we probably need to pre-qualify this with Jim to see where he's actually based, because if they're in the US, need to avoid PFICs, and everything he's sort of put in his questionnaire is mostly a PFIC. So need to definitely pre-qualify it next time.
Definitely, and I'll address the issue with Copenhagen, and it is a peculiar one because when we first heard about it years ago, I'm like, what? So essentially the way they work is they're very pro Copenhagen ETFs. So if you don't have an ETF domiciled in Copenhagen, what they do is a mark to market. The way this works is they'll take the starting price on the 1st of January and the closing price on the 31st of December. And if your ETF, which is foreign, so holding a Vanguard would certainly be that, then you will pay capital gains tax on the unrealized gains. So even if you haven't sold, but let's say it goes up 10%, then you'll pay tax on 10%, even though you haven't sold. The catch is, if it goes down, you don't get a tax credit. So they get it one way. So long story short, Jim, if you are looking at Copenhagen as the next destination, which is a stunning city, by the way, lots of Aussies there, you can't use a Vanguard in that case.
Yeah. And if you're in the US, let's have a chat, just because I'm nervous about those ETFs you've quoted. In the meantime, mate, let's move on to the next question provided by Hani, or Hani, sorry. And it's a good question. It's not my realm because I'm not over there. It's more probably for you, mate. So I'll throw it out to you. And it's mainly about the Dubai property market as a whole. You know, what's driving it, what has been driving it, you know, its growth, and I suppose what's the current market like over there at the moment?
Look, to me, it's like any other market around the world, driven by supply and demand. So on the supply side, it's the amount of developers releasing new stock.
Yep.
And on the demand side is both the incumbent residents as well as new people arriving into the country. So you do get this bit of a tug of war scenario, and we have seen property prices in the UAE just go through the roof in the last couple of years. And that was mainly because, there's a lot of people who came to Dubai because they're one of the first countries to be able to open borders and, you know, people to get on with their lives and their jobs. But second of all, because there was a slowdown in the construction side, there was less supply. So there was actually a shortage, especially, you know, there was quite a peculiar one here where primarily, I wouldn't say most of the population, probably most. I never actually worked it out, but I'll go with most, and someone can correct me if I'm wrong. Most people live in apartments. Yep. And when we went to the lockdown in the UAE was pretty strict in terms of you could not set foot out of your door. If you wanted to go to the supermarket, you had to get the police app and apply for a permission pass. You could go 3 times a week. So there's no exercise. The dog needs to take a leak. Doesn't matter. Not happening. Because of that, and with the advent of work from home, when people were able to get out of their leases, the first thing they did was run to villas. So villas, to those out there who don't know, they're like our version of a house is here. Having more space, you know, even for a couple who don't have kids, you know, husband and wife working, you know, they needed their separate space to be able to do their Zoom calls and work in a productive manner. So suddenly an exodus of people came out of apartments into villas. There was no new villas being released because COVID. There was a lot of, you know, development going on, and there was a lot of people coming into the country. So that just blew things up. Then we had obviously the Ukraine issue, which is just recently, obviously back in February this year, and a lot of both Ukrainian and Russian citizens came to the UAE because obviously from a Ukraine point of view, you know, they needed to go somewhere safe, and from a Russian point of view, they couldn't work because they had no ability to use the SWIFT channels and payment terminals and all those things. So a lot of them came here as well. And we're not saying all the Russians that came to the UAE are oligarchs and trying to hide from sanctions. You walk around, there's a lot of families. There's not a lot of normal people. So, but obviously from their point of view, whether there was, you know, sovereignty or geopolitical risk from their point of view, or the inability to earn an income, I don't know. You have to sort of do a survey of them, but you know, that has created certainly a lot of demand as well. So you've got a lot of people coming in, a lot of people moving around, creating that demand. Now we're starting to see the developers are ramping up. There's a lot of new supply starting in the market. And it's the UAE and especially Dubai rental rules and the landlord rules have changed a lot for the better in the past couple of years. And this year alone, they're now talking about doing direct debits for rent instead of checks. And yes, folks, Dubai and UAE love their checks. So if you've been here before, you understand exactly what I'm saying. So when that came out, we're like, oh, thank God for that. We don't have to write, you know, 12 months with post-dated checks. To me, it will settle down. It will, you know, there was a big rule change. So for the calendar year last year in Dubai, 2/3 of property transactions were via cash. So that gives you an idea of what's going on here. People virtually walk around with briefcases full of cash buying properties. Just recently, they passed a new law that said that if there's a property transaction going on greater than 50,000 dirhams, then the UBO's ultimate beneficial owner and details of the transaction must be reported. So what that means is no more cash transactions. And that was for both cash transactions and also to using digital currencies like crypto. So it might take out the sting and the hype now that if people wanted to park money around the world in a relatively safe environment, that may come out as well too. So look, I'm no Dubai specialist. I'm just talking from a person who lives in Dubai and watches this on a daily basis. You'd have to say that with interest rates rising, now people who were going to move to Dubai, the majority are here. There's a lot more people coming in, but now we've got more supply hitting the market, these new rules. I would hazard a guess to say things are going to settle down.
Demand might, calm down a little bit.
And that's obviously a lot of expats out there would breathe a sigh of relief, especially from a rental point of view, because rents have been going, like we've seen rents double in some places.
Yeah. Yeah. Crazy.
It's been ridiculous. So fingers crossed, as we say here, inshallah, things settle down and the next 12 months a bit more normal. But it does,
Yeah.
Dubai does have those big peaks and troughs when it comes to fluctuation.
Well, I mean,
those rental
speaking
prices
to
days.
speaking to those peaks and troughs, do you reckon a lot of the visas that they brought out just in recent years have encouraged that as well, like you said?
Oh, 100%. You know, we're talking to a lot of Aussies coming out of Australia. And, you know, in a massive wider range of businesses. And now, because you can do these freelance visas, they're saying, well, I don't have to be in Australia. I can still do my job. And if their job is primarily overseas and they're just doing it from Australia, why not do it in a place like Dubai? So we're having, I wouldn't say daily conversations, but certainly weekly conversations with a lot of folks back in Australia who are currently investigating their options because, it's almost like a land grab from an expat point of view that Dubai is trying to do. You know, there's a lot of folks coming out of Hong Kong into Dubai. Some coming out of Singapore with their localization rules that's going on, but also to just people in general. I mean, there's a 3-hour time difference between London and here. So you could actually quite easily work on London time. Just mean you start the day at 11 o'clock in the morning instead of 8. And it wouldn't be too much of a disadvantage. Yeah.
No,
and
not at all.
And you don't have to worry about the London winters.
That's true. One of the most depressing, No, that's been a terrific sum up there of the Dubai property market. I mean, as you mentioned, every property market is impacted, I suppose, by similar forces. To be honest, I mean, the demand has been so high over there. It makes sense that rents have gone up, income yields, and so is obviously the hotly contested market, and developers obviously moving quite quickly there. But I suppose, I agree. I think as interest rates have gone up, demand's going to slowly settle down. I think we've seen that obviously start to happen in the Australian market. We know that you read your local weekend newspaper and there's definitely going to be a few articles in there about the property market and the pullback in Sydney and Melbourne and those sort of things, which is pretty normal, to be honest, given we're not even at that sort of neutral position of 2.85% cash rate. We've still got another 0.5% to go there. So I think it's pretty normal to assume that things will settle down.
Yeah, I think so. I mean, unless there has to be a bit of a black swan event to either kick it up more or make it crash. So it's just that sort of, I always say, you know, it's like a pendulum. It always overextends on either side, but it always finds the mean over time.
Yeah.
And just with new property regulations and those sort of things, I think a lot of that saucy hot money may start to quieten down and, you know, just get back to a normalized market.
Yeah, absolutely. Couldn't agree more. And I think we'll see it happen probably in the next 6 to 12 months. It always takes a little while, doesn't it, to feed into the local economy?
It does. So, but mate, I think we'll wrap it up there. Homework time, guys. Obviously, links below will be to the Dubai and Abu Dhabi session. I promise you, and I did that in the last one, but I do promise you that this is worth your while to attend. If you've got a question on the new tax rules, you got questions on mortgages, Jeremy's an ace. He'll be going through all this in great detail. James and I'll obviously be talking about super investments and what you need to do in a rising interest rate environment. And then last of all, the bit that most people enjoy the most is the Q&A. You know, have a beer with us after, ask us questions, and we're pretty friendly guys. We'll hook you up.
Sounds good, mate. In the meantime, I'll be seeing you in 48 hours.
Yes, mate. Look forward to seeing the airport, and to the folks out there, we'll see you next Friday.
Sounds good, mate. Speak soon. Cheers.
Thanks, mate. Take care.